And the third point, that if you are thinking from an European founder perspective and you are sure that you want to move to the States, it's worthy of thinking about where in the US do you want to be located? Because historically, more than half of all US venture deals take place in the largest four ecosystem, like we talked about earlier.
Today, we are excited to host Kaidi Gao from PitchBook, where she serves as an analyst in venture capital. Kaidi is at the forefront of venture debt, seed, and early-stage investments, especially within the US and Asia-Pacific venture capital scenes. Her expert analysis has been a cornerstone of PitchBook's flagship venture capital reports, offering invaluable insights that guide both investors and entrepreneurs through the complicated venture capital ecosystem. With a master's degree in Near Eastern Studies from Princeton University and a bachelor's degree in Asian and Middle Eastern Studies with a focus on Arabic from Duke University, Kaidi embodies the intersection of traditional finance and the forefront of technology. Originally hailing from Beijing and now making waves in Seattle, her unique perspective is a navigational beacon in the complex venture capital waters. Please join me in welcoming Kaidi Gao. Harder, better, faster, stronger. This is the title of an article in The Economist about the market capitalization of VC-backed companies valued at over 1 billion when comparing to USA and Europe. And it's just astonishing. It's 5 times more valuations in the United States compared with Europe. So, Kaidi, can you explain the forces behind these trends and the current situation between the USA and Europe?
For sure. So let's start everything in the context of deal making. In the US and in Europe, we actually saw pretty similar trends in terms of declining from recent years of market heights, essentially the market corrections that are coming from the 2020 and 2021 capital exuberance. But the scale is very different because, on average, the valuations in the US is much higher than what we see in Europe. So the scale can actually be illustrated if we look at the deal making activity for these two regions. So if we take the 2021 peak of the market as an example, the VC deal value in Europe was roughly 1/3 of that of the US, but the deal volume was actually comparable, which suggests to the US having larger deal sizes across the board. And if we look at 2023 figures, the US has roughly 3 times the deal value that of what we saw in Europe, but 1.6 the total deal count when compared to Europe, which again suggests a similar theme of smaller deal sizes in Europe. And if we really put that into context in terms of figures, US VC deal value in 2023 was roughly 170 billion that's invested across approximately 16,000 deals. And in Europe, that was roughly 58 billion euros invested across a little bit less than 10,000 deals. So already you can see from the data of that scale. So in terms of, to your point about what are some of the forces that driving the recent decline in venture deal activity, there are several factors that play into it. So first of all, there was that interest rate hikes that happened within both contexts, which then in turn led to the price of multiple corrections coming from the public market. And that exerted a downward pressure. That downward pressure that first emerged from the growth and late stages, and then that pressure actually trickled down towards the earlier parts of the venture ecosystem as well. And in addition to that, from the LP side, we saw a liquidity crunch, especially when it comes to institutional investors. And that in turn led to a slower pace of committing capital to venture funds. And that again, in turn, led to a slower deal making pace from the GP's part. And the third point, but last but not least, is the market frenzy in 2021 in terms of the fast pace of deployment was actually just unsustainable in itself. So what we saw from the past 2 years was, rather than speaking about a collapse, is more about a healthy reset of the venture ecosystem.
But from the perspective of a startup, When I pitch to European VCs, I just don't get a lower valuation, hence less money compared with the USA. Is that
Right.
correct?
I think there are many factors that play into it because when we talk about startups, there's so many things that are within consideration. Say, what stage are you operating in? What industry sector? Or even within specific industry sectors, there could be subsectors that are subject to different opportunity sets, or there could be opportunity when it comes to Gen AI, or what are some of the government support that's coming into play. So there's actually a variety of considerations when we talk about valuations.
Okay, but we have seen a significant drop in value from mega deals. So what's happening with the early stage startups
Yeah,
in terms of these drops of valuation?
for sure. Mega deals are really important. We define them as deals that are at or above $100 million. And the reason why they're significant is because overall, historically, these mega deals help prop up the total deal value. And what we saw from the US context is that from 2023 or 2022 and 2023, there has been a sharp decline, as you pointed out, from the 2021 peak in terms of deal value and deal count when it comes to mega deals. And at the core of this is really a pullback of non-traditional investors or investors that are not that are other than the traditional venture funds, say the asset managers or PE firms or sovereign wealth funds, etc. But I would love to highlight the point that it really has to do with the market at the time. In terms of 2021, there just a capital exuberance, and there were a lot of these non-traditional investors coming to VC, coming into this asset class because exits were happening at an extremely fast pace, and the IPO market at the time was doing great. So they're really capitalizing on that window of being able to make not short-term gains, but being able to realize returns at a much faster pace. But that pullback was actually not so much of a concern when it comes to the pre-seed or seed when it comes to pre-seed or seed stage operators or the earlier stages of or the earlier stages of startups, because we actually saw a high level of resilience at the pre-seed and seed stage in the US context. And there are several factors that play into that level of resilience. First of all, these startups are more insulated from the headwinds that are plaguing their later stage counterparts or their more mature counterparts, because these earlier stage of startups still have a long time to grow before they have to formulate an exit strategy. So that benefit of time is actually protecting them from all the severe headwinds that are coming from the correction of multiples in the public market. And this is especially true because startups in general are staying private for longer. And in addition to that, there is a proliferation of regional funds that are typically smaller, that are dispersed across the US venture landscape, that are able to support these earlier stages of startups. And there is actually a caveat here when we talk about the data in terms of the valuation staying stronger, because what we have observed is a flight to quality from the investor side. And the selection bar for GPs to make new deals is actually a lot higher. So if we look at the valuations that have gone up for the earlier stage startups, I think it's really easy to draw the conclusion that, oh, the startup market is doing great. But we actually need to look beyond that to see that, oh, it's actually the higher quality startups that are able to secure funding in such a difficult financing environment in general. So I would say in terms of startups and investors, yes, the funding climate has become a lot harder, but investors are also seeing better founder quality, especially when we're speaking with founders that are when we're speaking with investors that specialize in early stage. Because when the financing environment has become so much more harsher, when you think about if you are a founder and you're like, should I start a company today? It's really the people that are truly committed to what they're doing. They're truly passionate and truly believing in themselves being able to offer that differentiated point of view and being able to draw from their perspective to really build a solid and robust business. These people are the ones that are starting a business today. So I'm not surprised to hear from investors when they're talking about better founder quality today. And the last point I would make on this point is that times of economic uncertainty or volatility actually calls for a focus on efficiency, a focus on being able to develop growth that are sustainable or responsible, that you are able to really generate unit economics that are solid, as well as really focusing on building enduring companies with a robust business model. So that's why there's still a lot of hope within the market.
So what I understand is, in other words, when there are there are high rates and investors get just enough alternative to invest apart from the early stage or like VC market, then if you want to start your company, then it really attracts the natural born entrepreneurs and not and less just because it's a hype that like just like everybody tries to become an entrepreneur, although they probably are not so talented. Is that correct?
Maybe, yeah, I would say in terms of founder market fit, there has been a renewed focus on that. Whereas if you think about in late 2020 or throughout 2021, there's so much capital availability. It's just easier for investors to be able to deploy that capital at a faster cadence. And we have definitely been hearing from even some of the longer standing venture firms saying that the 2021 market was just such a unique time that even though historically we have been really prudent, that we really place a lot of emphasis on due diligence, but when the market in general is really competitive, that there's so much capital out there that we have to make a decision within such a short time window, that even some of the long-standing venture firms were doing things that they typically wouldn't do in a so-called normal um in a normal market or a normal year. So we just wanted to highlight that time is really different. Whereas if you look at 2023 or today, entrepreneurs themselves, they are keenly aware that, oh, the valuations level has declined across the board, and investors has become a lot more cautious when it comes to capital deployment. When they really think about, is it the right time to start a company, there are a lot of question marks around, will I be able to secure that funding? And actually, I think something that I heard from investors that's been really inspiring and shines a light on today's market dynamic is that some of the investors that I spoke with, they were saying one of the questions they asked is, if the entrepreneurs that's pitching to me today gets declined for capital deployment from every single GP that they talk to, will they stay committed to what they're trying to do? Will they stay committed to the company that they're hoping to start today? If the answer is yes, then that clearly points to that level of passion and commitment, and moreover, that level of founder market fit. Do you
Mhm.
believe that you are the best one to execute on the idea? Because likely the idea is out there. There could be a lot of your competitor trying to start the same type of company, but are you the best bet?
Yeah, are these guys insider and they really have a comparative advantage towards other entrepreneurs? So that's what you
Right.
talk with like founder market fit, right?
Exactly, right. It could be drawing from a variety of sources. Say it could be from a personal experience that made you extremely passionate about a topic, or it could be coming from operational experience that you previously worked at XYZ firms, and you previously had this hobby, this side project, and the combination of all your educational background, operational experience, and maybe even some of the investing experience. So it's really the whole umbrella of everything that you have been doing for the past life before embarking on that entrepreneur journey.
Absolutely. So then so Europe has like 450 million inhabitants, and the United States is smaller with 350 million. Nevertheless, the market is just offering more to the startups. When I want to go to the United States, where shall I go? To Oklahoma, to Seattle? Where is the music playing in the United States?
For sure. If we talk about the US VC deal making activity, I think it's important to, like you said, to think about, okay, where is the best fit? Because US is a large country. You can't just say, I'm coming to the US. Okay, where exactly are you planning on going? So I think to offer a bit of a context, it's important to highlight the domination of the four largest ecosystems in the States. That is the Bay Area, Los Angeles, New York, as well as Boston. And already from the mentioning of the four ecosystems, you could tell that they're really concentrated along the west and the east coast, the two coasts of the states. And the reason why I'm talking about the domination is because throughout the past couple of years, we had seen roughly half or more than half of the deals happening within the four largest ecosystems. And by deal count, a positive message I can share here is that we had observed a healthy trajectory in terms of a trend for the other ecosystem to catch up. And what I mean by that is that we had seen diversification of capital in terms of more deals happening in ecosystems that are outside of the four largest markets, say Philadelphia, Washington, D.C., Seattle, Denver.
Austin. Oh, yeah.
Right, exactly. Like you said, we had seen more deals happening in these places. And part of the reason why that's happening is because again, it speaks to what I mentioned about the proliferation of regional funds that are typically smaller, but even though they are restricted by their fund size to write larger check sizes, they have been playing a really important role in terms of supporting entrepreneurs that are operating in these ecosystems. I would like to highlight that during market contraction or during times of market volatility, there is that tension in terms of investors thinking about, well, maybe I should move back to the core markets. And that's what we have been seeing, that if you think about during the height of COVID, there has been all this shift in terms of moving the meetings online, having the first conversation, having the first set of conversations between the entrepreneurs and the DPs via Zoom calls, which is hugely positive because then you're bringing a lot of these dynamics into the entrepreneurs within, say, Oklahoma or outside of the major ecosystems that historically would have missed out on the opportunity to have that first meeting with the investors. But then what we have seen, especially in 2023, is that when the pandemic dynamic in terms of Zoom calls have fade out a little bit, and when there's still a heightened volatility within the market, there is that, I would say, tendency for investors to revert back to what they're most comfortable with. And by what they're most comfortable with, it could just mean meeting entrepreneurs that are within driving distance or preferring to meet with people that are within their network, which definitely speaks to disadvantages for, say, your founder in Nebraska or Oklahoma, and you wake up with this amazing idea. You could be trapped within this ecosystem that just doesn't have as many opportunities when it comes to capital deployment.
Yeah, and also what we have seen is that young people prefer to go to a city and meet each other than staying home. Yeah, probably that was also a little bit generational topic, that older generations prefer to stay home and have this flexibility to work from home in a certain amount. But yeah, it turned out that these young, especially young founders, they prefer to be in a city and meet other people. Have you also come across this phenomena?
I I think it's a different dynamic when it comes to work remotely because there could be the younger generation loving to, but there could be part of it, people loving to work from the office and just meet their peers to have face-to-face conversations, or there could be people that prefer to work remotely but still wanting to build a team. So I think that would lead to another set of really interesting conversation that talks about the SaaS landscape, because there has been a lot of technology that are, and the dollars that are putting into HR SaaS technology that are tackling those employment problems or issues that are newly emerging with the younger generation, as well as the remote work dynamics. When it comes, I have definitely heard from founders themselves when they're thinking about starting a company, especially if they're not living in New York or Bay Area, that they really prefer to be within that community, whether that be attending an accelerator or just meeting people casually in a social setting, because they love to, I would not, I would say seeking, not like venting to each other about how difficult it is to start a business, but more asking for collaboration or seeking collaboration, asking for advice, or just soliciting what their peers have been observing from the market, exchanging thoughts. There could be a lot of benefits that coming from living within that community.
Yeah, I just I wrote this blog, and then I also was mentioning these hacker houses in Hayes Valley in San Francisco, where all these AI startups meet, move into a house, an old villa or whatever, and work and live together like a community, and build their startups. Also, they have more exchange. They meet in the coffee, next door or across the road. Yeah, I just feel like that the startups. I think when I imagine that I have to get restarted, when I could go back and would be young, I would prefer also to move there and be part of this whole community instead of staying home and having Zoom calls. Yeah.
The idea of community is a really important point. I actually remember hearing from both LPs and GPs and talking about how when they're looking at portfolio companies, a lot of like from the GPs, from investor perspective, a lot of them actually prefer to have early stage companies to have more of at least a hybrid component where you have some days of the week that the team is coming together, having face to face conversations because like you said, I do believe that remote work offers a lot of flexibility, that there are advantages as a startup that you can play into by tapping into that talent pool that are more diverse, that are dispersed across the ecosystem. If you are hiring people, bringing on board people across various cities, but there is also a lot of benefit, especially for early stage startups, for people to actually to be having face-to-face conversations or like you said coding alongside each other or just having those conversations that are maybe you come into the office and you chat at the kitchen over the first cup of coffee on Monday morning and some inspiration come to your mind. There could be a lot of benefits that come from that.
Yeah, talking about discussions, we all had also discussions among our startups in the accelerator, and it was about, and I pitched the first time. Then at the last slide, it's always how much money they want for what valuation, and this valuation differed so tremendously. So that was very funny to have this discussion. But you can now help us and make a clarification as what valuations do you look at when you have early and subsequent stages? What is the level? What are the standards of these valuations in what stage?
For sure. Let's first, I think there are two things that go hand in hand, which is deal size and valuations. I would start with providing a context for the deal size by stage and then go into valuations and then talk about what are some of the factors that are driving those trends. So if we look at deal size by stage, that is seed, early stage and late stage in the US. For the median seed deal value, that has what we saw is that the figure has consistently expanded during the past decade and it plateaued a little bit in 2022. And the value for median seed value, the value for median seed deal value is 3 million in both 2022 and 2023. And when it comes to early stage, the median deal value figure actually dropped from 2022 and settled at approximately 5 million in 2023. But this is still above the 2020 level of 4 million US dollars. And if we think about late stage, the median late stage deal value experienced actually a pretty sharp decline in 2023. It landed at approximately $6 million, which is slightly below the pre-pandemic level. And this has a lot to do with the headwinds that are coming from the public market, as well as the volatility from the macro picture. And why is the case in terms of all the numbers that I just listed out? So first of all, what we have seen in the market is that at the early stage, there are still a lot of funds that were raised during the past few years that are still within the active investment period. So that's keeping the pace of making deals and really propping up the momentum at those earlier stages. And in addition to that, from a company perspective, just because, like we mentioned, how difficult the fundraising environment has become. And because of that, some startups are purposely trying to raise more capital to make sure that they have sufficient runway to get them to the next inflection point while they work on developing, while they work on really doubling down on their core product and making sure that they're making enough progress, both when it comes to product as well as financial metrics, so that they can get to the next financing round. At the late stage, we actually saw a huge crunch in terms of a misbalance when it comes to capital demand to supply, because we actually have a proprietary PitchBook quantitative model that measures for each dollar that startups are actually getting, how much are they demanding, and we saw a huge misbalance in terms of a lack of capital supply to the more mature companies. And roughly, if we segment the US market into two areas, we are looking at the earlier stages doing relatively better versus the late stage counterparts having a more difficult time in general. And actually, if we shift gears to valuations, we have been seeing similar trend when it comes to valuations, that across the globe, the ones that got hit first are the ones that are closest to the public market. But the earlier stages are more insulated from the headwinds because they're further away from having to make an exit anytime soon. If we break down valuation by stage, that is again seed, early stage, and late stage. In the US, the median pre-money valuation in 2023 dropped year over year across all the stages for the venture lifecycle, that is pre-seed, early stage, late stage, as well as venture growth, except for seed. The later stages in particular experienced a pretty pronounced decline over the past 2 years. And in Europe, interestingly, we actually saw quite the opposite trend, because the 2023 median pre-money valuation actually ascended year over year across all stages. And by all stages here, I mean pre-seed, early, and late stage VC, apart from seed and venture growth stages. The median venture growth stage pre-money valuation actually ticked up from roughly 29 million euros in 2023 to approximately 31 million euros in 2022, before sliding to 23 million euros in 2023. So what are some of the factors that play into the pronounced discrepancy in valuation trajectories for what we saw in the US and what we saw in Europe? There are several factors that come into play. First of all, in 2021, the European venture market was not subject to the same level of highly inflated deal volume and valuation as we saw in the US context. And as a result of that, the ensuing price correction in the European private market was relatively mild if we compare that to the US context. In addition to that, starting from about mid 2022, the US venture ecosystem actually saw a pullback of non traditional investors, like we mentioned earlier, your asset managers, your sovereign wealth funds, your crossover investors that historically infuse massive amount of capital to mature startups to capitalize on the near term gains during a bull market. The capital void that happened subsequently led to a collapse of valuations for mature startups in the US. And this stands in contrast with Europe, because the region historically suffered from a lack of growth stage capital supply. The last point I'm trying to make is that there's also that survivorship bias, that during the past 2 years, the fundraising climate in the US has become a lot harsher compared to the 2020 and 2021 bull market. And the same can be said about Europe as well. While it's easy to draw the conclusion that seed valuations in the US has remained robust, the data actually masks a really important underlying reality, that the selection bar from an investor perspective have gone up significantly and revenue multiples have declined, which results in only the highest quality startups being able to gain traction and secure equity financing.
Yeah, so when you have a look at the slide 17 and 18, can you explain these two slides real quick one more time, especially in comparison between Europe and the United States?
For sure. Yeah. So what I was mentioning earlier is that the trajectory when it comes to valuations broken down by stages that the startups are operating in are quite different when we are comparing the US and Europe, which is really interesting, because overall, even though deal making activity has been declining in both of the ecosystems, the valuations trajectories differ by if we are drilling down in terms of the stages of operation. And one of the driving factors behind that is historically in the US, we see a relatively robust and comprehensive capital support throughout the venture ecosystem, whereas that's not really the case when it comes to Europe, because historically there is a lack of capital support for more mature startups. And by that, I'm talking about the late stage as well as venture growth stage startups. And that in combination of a pullback of non-traditional investors from the US context, as well as relatively more heightened deal making activity level in the US, the heightened inflation of deal making activity and deal volumes in the US when the market was during the bull market, that results in a level of correction in Europe that's relatively mild. When I talk about a historical lack of venture growth stage and late stage capital support, that just means that because historically that has always been true, so the correction that we're seeing in terms of the valuation reset for the more mature startups, that's just relatively more mild in the European context.
I got it. Okay. Talking about growing your company and getting into the later stages, can you talk about exit strategies and compare it again between the United States and Europe?
For sure. Looking across the markets, we could say that in general, IPOs or public listings, especially the tech IPOs, the large ones, where are especially the large ones are going to be where the most returns come from. And exits in general across the two markets have been down, but the returns generated in the US tech, especially the US large technology companies, are going to keep many investors engaged in that market. So if we look at the US and Europe, I think the similarity is that IPO level has been down. That's just true for both markets. But what's different is that if we are drilling down into the challenges for each of the market, that paints a different picture, because in Europe, that is relatively more fractured market, because you have all these different countries that have all these different laws and cultures and different listings. Whereas in the US, you have a large single market that is an enormous economy, and the challenge for growth in terms of from a company perspective is more in terms of how do I maximize market share versus cross-border expansion from day one when it comes to a European founder perspective. So the cross-border expansion from a US perspective can come later, but that's really not the initial concern for US startups as compared to some of the other smaller markets within Europe.
And so you just mentioned it. How exactly does the fundraising environment differ between these two regions?
For sure. So from a US perspective, we had seen a lack of large exits, which really led to a liquidity crunch from the LP side. And that is actually from the US perspective, we had seen a lack of large exits, which in combination of many other factors had led to a liquidity crunch from the LP side. And actually from both markets, we had seen the factors of interest rate hikes and other areas of private markets appearing to be more appealing coming into play when it comes to headwinds for venture managers trying to secure commitments from their LPs. And from the European context, let's put some numbers from the European perspective, let's talk about some numbers to put everything into perspective.
Hmm.
So in 2023, roughly 17 billion euros was raised by venture managers across 141 funds, which reflects a near 40% year-over-year decline in terms of total capital raised. And venture fundraising in 2023 has dropped below 2016 level, both in terms of commitments secured from LPs as well as fund counts. So what that means is that the fundraising level has really slowed down for both from both European and US perspectives. But I would say the difference is when it comes to the scale.
Yeah, and what we see in the scale is in the United States, when you have to take the last 4 years, 2020 till today, they have raised in total 500 billion compared with 100 billion in Europe.
In terms of the 500 billion, that's when we are adding up all the fund figures or adding up all the capital that has been raised by venture managers from 2020 to 2023. So that's actually an aggregate figure. And the
Hmm.
title, when it comes to European VC fundraising activity, that just focuses on 2023. So if we were to compare the figures for venture managers when it comes to fundraising figures, 2023, you're right. It is just 17 billion euros in 2023 for Europe. And if we look at the US, that is roughly 67 billion US dollars. I agree with what you mentioned about when we look at data, it's not just a single picture. There are so many caveats playing into it. There are so many underlying factors that when we are looking at it, we always need to combine the qualitative as well as the quantitative aspects of the data. And if we think about the fundraising figures, I'm not surprised to see Europe having a lot less capital because if we think from a global perspective, that's just historically what we have been seeing, that the venture market in the US, because it's the largest ecosystem from a global perspective. It also has a large volume of startups. It has the longest tradition for venture capital because VC actually originated here in the States. But I think overall, we are seeing a global pattern of other ecosystems trying to catch up and slowly,
Absolutely.
gradually evolving themselves. Yep.
Absolutely. So last but not least, where does that money come from, these 500 compared to the 100 in Europe? So where does this money come from in the United States?
For sure. I think if we just talked about fundraising, and a really important point that relates to it is really dry powder, by which we define as the amount of LP commitments secured by venture funds that have not been called yet and can be deployed into the venture ecosystem.
So
And
there's
if
even more money. There's even more money.
there is a lot of capital, but I think as to your earlier point, there's a lot of caveats that we really need to look beyond the simple dry powder
Mhm.
figure, right? So if we zoom into the 2023 figures for dry powder, actually 60% of the dry powder in the US belong to funds that are over 500 million US dollars in size. And in Europe, 40% hangover is basically the same term as dry powder. So 40% of overhang sits at funds that are more than 500 million euros in terms of AUM. And the discrepancy, again, really illustrates Europe's historic lack of growth stage capital.
Okay. Yes. What does that mean for the future? So let's talk about the next 5 years. When you are a startup, would you go to Europe or to the United States when you have a 5-year plan?
For sure. I think there are a lot of factors that play into it. And there are, so first, if you think about, because as a startup, there's so many things that could influence your future trajectory or which market fits you the best. If we just think about the geographic differences, I think there are many things that comes to founder market fit, or many things that comes to even some personal considerations. Where does your family want to live? And if you want to move to the States, do you see yourself here? And if you do want to move to the States, which ecosystem do you picture yourself? And then when it comes to businesses, it also pertains to which sector do you operate in? And within that sector, which subsector? And is there already a list of investors that you feel like, oh, like for future financing or even just to pick the investor's brain, do you see yourself as a fit for, maybe you have already identified a list of investors as well as your peers of entrepreneurs that you find a lot of inspiration from. So there are a whole laundry list of things to take into consideration. But I think just to add on to what we talked about, the dry powder, I've been asked several times by founders reaching out and saying that, hey, what does the level of dry powder mean if I'm an early stage investor or if I'm a late stage investor? How do I interpret that dry powder level? So I wanted to take the opportunity to dive a little bit deeper in that. So in terms from a founder perspective, it's really helpful to approach dry powder by thinking about it from the following angles. So first of all, which stage of operation are you in? Because for early stage startups, it's not really worth the time to be fixated on the overall dry powder level, because nascent startups do have the luxury of time that they can focus on achieving PMF or improving unit economics and scaling growth, all the things before you have to strategize on an exit that's years from now. Whereas for mature startups, they face a much stronger headwind in the market at the current moment. Investors have become a lot more cautious with capital deployment because of compressed valuations, because of frozen paths to public listings, as well as that lingering pricing gap for M&A. So the elevated level dry powder actually speaks to the sideline capital from the mega funds that are active in later stage deals, and is less relevant to early stage companies. And in addition to that, I think it's really important to think about, like I mentioned, which industry sector do you operating in? Because for budding startups, it's worth considering generalist versus specialist firms, with the caveat that a lot of large scale generalist funds could have teams or individuals that specialize in certain industry verticals. And especially if you're going after something that's very niche, very specialized, it's really worthy considering, do I have a list of investors, or do I have a list of investors that I'm thinking about targeting, or am I going into an ecosystem that has that level of support, in whether that's coming from a founder community that you can pick your peers brain, or when it comes to that level of capital supply. And the third point, that if you are thinking from an European founder perspective and you are sure that you want to move to the States, it's worthy of thinking about where in the US do you want to be located. Because historically, more than half of all US venture deals take place in the largest four ecosystem, like we talked about earlier. And from recent years, we actually saw trends of diversification, with ecosystems such as Philadelphia, Washington, D.C., Seattle, Denver experience an uptick in terms of deal making with support from locally based funds. But then again, there is that caveat that there are a lot of these regional funds could be smaller. So if you are thinking about, oh, 5 years from now, if I'm ready to raise my later stage venture funds, then the locally or the regionally based funds may not have that level of dry powder to support your later entrepreneurial journey.
That was super helpful. That was great. Listen to you, and thank you very much that you made this analysis and set up these slides. Super helpful. I read a lot about this topic. I listen to many podcasts. This is really a clarification and everything to the point. Thank you very much.
Thank you, Fab, for the opportunity. Really glad to be able to share our observations and just what we've been seeing from the market and hearing from investors and LPs. I know that venture is unfortunately a very opaque, it could be an opaque space. And there are a lot of times from a founder perspective or even from investor perspective, people are looking for information. It might not be readily available in an easily accessible way. So as a podcast lover myself, I appreciate the opportunity to be able to share everything here.
And it's a super dynamic environment. And I'm sure we coming back and ask you for another podcast later when things have changed again.
Absolutely. Look forward to it.
Hey, have a nice week. Thank you very much. Bye.
You as well. Bye.